Taxand Tax Updates. Disclaimer. The following information is intended only to be a guide. It must not be relied on in or applied to specific situations without previously seeking proper professional advice. Global Minimum Tax Provisions, or Pillar 2 of BEPS 2.0 in Indonesia. The government has implemented the global minimum tax provisions of 15% in accordance with Pillar 2 of BEPS 2.0 through Minister of Finance Regulation Number 136/2024 or MOF Regulation 136/2024, which was promulgated on December 31, 2024 and came into effect on January 1, 2025. The Global Minimum Tax Provisions, or Global Anti-Base Erosion Rules, or GloBE, are additional tax provisions developed by the OECD or G20 Inclusive Framework, or IF, on base erosion and profit shifting, or BEPS. Global Minimum Tax, or GloBE, is imposed on domestic tax subjects and permanent establishments, which are constituent entities of multinational corporate groups or MNC groups, under the following criteria. A. The MNC group's annual gross turnover is at least 750 million euros based on the consolidated financial statements of the primary parent entity, and B. The gross turnover value in point A is met in at least 2 of the 4 fiscal years prior to the fiscal year subject to GloBE. However, there are also constituent entities of the MNC group that are excluded from GloBE, namely government agencies, international organizations, nonprofit organizations, pension fund entities, investment fund entities that are primary parent entities, and real estate investment fund entities or real estate investment vehicles that are primary parent entities. Global Minimum Tax, or GloBE mechanism. 1. Income Inclusion Rules, or IIR. IIR is a provision that imposes additional tax on domestic tax subjects who are primary parent entities in the event that other constituent entities of the MNC group that are owned directly or indirectly are taxed at an effective tax rate less than the minimum rate of less than 15% in the country or jurisdiction where the other constituent entities carry out their business activities. Additional tax based on the IIR is imposed on domestic tax subjects who are A. Primary parent entities, B. Intermediate parent entities, and or C. Partially owned parent entities, or POPE. For additional taxes imposed on the intermediate parent entity, an exception is given in the event that A. The primary parent entity in another country or jurisdiction applies the qualified IIR for the fiscal year, or B. An intermediate parent entity in another country or jurisdiction which applies the qualified IIR has a direct or indirect control interest in the relevant intermediate parent entity for the fiscal year. 2. Undertaxed Payment Rules, or UTPR. UTPR is a provision that imposes additional tax in the event that the IIR provisions are not applied and or the additional tax has not been fully imposed on domestic tax subjects who are constituent entities of the MNC group in the event that other constituent entities of the MNC group are taxed at an effective tax rate less than the minimum rate of less than 15% in the country or jurisdiction where the other constituent entities carry out their business activities. Additional tax based on UTPR is imposed on constituent entities in Indonesia that are part of the MNC group, except for investment entities, after being reduced by the allocatable portion of the additional tax based on the IIR to the parent entity. However, the additional tax of a constituent entity becomes zero if all ownership interests of the primary parent entity in the low-tax constituent entity are directly or indirectly owned by one or more parent entities that are required to apply the qualified IIR. 3. Domestic Minimum Top-Up Tax, or DMTT. DMTT is a provision that imposes additional tax on domestic tax subjects who are constituent entities of MNC groups that have an effective tax rate less than the minimum rate, less than 15%. Additional tax based on DMTT is applied to each constituent entity of MNC groups, whether owned in part or as a whole by other constituent entities in the MNC group in question, without taking into account the inclusion ratio. Indonesia is required to meet the qualifications set by the OECD or G20 Inclusive Framework on BEPS to use the DMTT. GloBE Profit or Loss. Calculation of GloBE profit or loss is done based on the net profit or loss of financial accounting of a constituent entity, which must be subject to general adjustments, elective adjustments, and special adjustments. The net profit or loss of financial accounting of a constituent entity must be adjusted to reflect the requirements of the provisions related to A. Restructuring of the body and ownership structure, and B. Tax neutrality and distribution regime. Calculation method. Constituent entities of MNC groups with net GloBE profit calculate the effective tax rate or ETR per jurisdiction for each fiscal year. It is calculated using the formula as follows. Effective tax rate or ETR per jurisdiction is equal to adjusted covered tax calculated per jurisdiction divided by net GloBE income calculated based on financial reports per jurisdiction. Meanwhile, the additional tax per jurisdiction is calculated as follows. Percentage of additional tax times excess profit plus additional current top-up tax minus qualified domestic minimum top-up tax. Additional tax percentage is equal to minimum rate of 15% minus ETR per jurisdiction. Excess profit is equal to net GloBE income minus substance-based income exclusion or SBIE. Additional current top-up tax is the amount of additional tax added in the current year related to a recalculation that resulted in an underpayment of additional tax in the previous year. Substance-based income exclusion, or SBIE, is the cumulative amount of additional tax exemptions on net GloBE income calculated based on a certain percentage of salary costs and the recorded amount of tangible assets for each constituent entity in that country or jurisdiction. Safe harbor. Safe harbor is the determination of additional tax for constituent entities as zero. Constituent entities of the MNC group can apply the safe harbor provisions if they meet the following tests. A. De minimis. B. Routine profit. Or C. Effective tax rate. The de minimis test is met in cases where the constituent entity has an average GloBE income of the MNC group in a country or jurisdiction of less than 10 million euros and an average net GloBE income of the MNC group of less than 1 million euros, or there is a net GloBE loss for the MNC group in a country or jurisdiction in the current fiscal year and the 2 previous fiscal years. The routine profit test is met in cases where the constituent entity has a GloBE income of the MNC group in a country or jurisdiction for a fiscal year equal to or less than the amount of the SBIE. The effective tax rate test is met in cases where the constituent entity has an effective tax rate of the MNC group in a country or jurisdiction of at least 15% for a fiscal year. Tax administration and reporting obligations. The annual income tax return, in order to implement GloBE, consists of A. GloBE annual income tax return, submitted by each primary parent entity of the MNC Group, which is a domestic tax subject, to report the calculation and/or payment of tax, taxable objects, and/or non-taxable objects, and/or assets, and liabilities in accordance with GloBE. B. DMTT annual income tax return, submitted by constituent entities as a domestic tax subject to report additional tax obligations based on DMTT. C. UTPR annual income tax return, submitted by constituent entities as domestic tax subjects to report additional tax obligations based on UTPR, all of which must be submitted by no later than 4 months after the end of the fiscal year. In addition to being required to submit the GloBE annual income tax return, each primary parent entity that is a domestic tax subject is also required to submit the GloBE information return, or the GIR, to the Director General of Taxes, or the DGT, by no later than 15 months after the end of the fiscal year. In the event that the primary parent entity of the MNC Group is not a domestic tax subject, then the constituent entity in Indonesia is required to submit the GIR to the DGT if the following conditions are met. A. The MNC Group appoints the constituent entity in Indonesia as the reporting constituent entity, or B. The reporting constituent entity is domiciled in a country or jurisdiction that does not have a qualifying competent authority agreement in force with Indonesia for the reporting tax year. Furthermore, each constituent entity of the MNC Group located in Indonesia must submit a notification to the DGT by no later than 15 months after the end of the fiscal year. However, in the case of a constituent entity located in Indonesia that has submitted a GIR, it is not obligatory to submit a notification. Upon submission of the GIR and notification, the DGT provides a receipt that must be submitted as an attachment to the GloBE annual income tax return. The due date for the payment of additional tax payable is by no later than the fiscal year after the GloBE imposition year, which is carried out in the Indonesian rupiah currency. First year exception. GIR for the first fiscal year of the MNC Group that meets the requirements must be submitted to the DGT by no later than 18 months after the end of the fiscal year, while the submission period for the GloBE annual income tax return, DMTT annual income tax return, and UTPR annual income tax return for the first fiscal year, during which the MNC Group that meets the requirements may extend for a maximum of 2 months. Validity period. Additional tax provisions based on IIR and DMTT in accordance with MOF Regulation 136/2024 will come into effect on January 1, 2025, while additional tax provisions based on UTPR will only come into effect on January 1, 2026.
Thank you for listening to PB Taxand Tax Updates.